Gives me great pleasure to bring you the Atma presentation of India charts on economic cycles and their confluence with Elliott wave analysis. Some of you have been asking for it for quite some time, and it's finally here. I'll try to make it as interesting as possible with some latest updates, and also try to bring in pieces of audio from the original presentation, and I hope you enjoy it.
Obtain the day for which I had been waiting for, to introduce a very illustrious colleague in our profession. Irrespective of the intense debates one can end up in with him, it's not him, it's the subject. And he's, I think, one of the most honest people I've met in the subject. Somebody who's as sincere as him is not easy to find. And it's an immense pleasure to have him come by here and share his knowledge with us, share his time with us. Please join me in welcoming Mr. Rohit Srivastav. His achievements are not something that can be described easily, they need to be felt. I think, he's an extraordinary human being. And howsoever deep debates we sometimes land up in, I've never seen Rohit getting ruffled up. I do get. So I do respect him for that. He's been managing the Protect Fund with Sheikh Khan, and it's a computerized system-based fund which has beaten Nifty left, right and center for as many years as the fund has been around. If I remember the numbers correctly, he made about 160%, somewhere around that, and Nifty has perhaps been up about some 40%. It had lost everything also in 2008, and now it's up 40%. And Elliott wave analysis is something which Rohit really focuses upon and believes that along with fundamentals and socioeconomics, it provides the missing link to the markets. Rohit, please pardon me if I don't get everything right fully, but I do always remember you're a great human being, and you have a certain way to look at markets, and it's always enjoyable to agree and disagree with you. So formally I'm handing over the day to Rohit. Please welcome him, and I do look forward to a great evening with him.
And what's so great about this subject is that it's really it's the simplicity, which is why it attracts everyone who gets into investment. I think the field of technical analysis, simply opening up a chart and looking at price becomes one of the first steps that any individual trader, investor thinks of doing. In fact, I consider the entire field, whether it is technicals, whether it is Elliott wave analysis, whether it is what I will discuss today, also the quantitative cycle. The concepts are very simple. Some people might be thinking Elliott wave, we can't figure it out for most people. The book, the Elliott wave principle, this is probably one of the smallest technical analysis books you can actually come across. And less than half of that book is dedicated to teaching you how to do Elliott wave analysis. The other half goes into making his forecast and explaining other aspects. So, through the presentation, I'll actually try and show you why it is simple. The difficulty really with technicals or any aspect of technical analysis is really, it's really us. It's the human mind, the human being, the acceptance of what we see visually, the simplicity that the chart proposes to you, and the difficulty with which your mind actually accepts that, yeah, this is what we see and this is what it is. You should be able to tell whether it's authentic or not. There's so much variation that has been applied to it, and in fact, a lot of people individually while applying will mess around with the basic structure because the basics are not clear. So what I will try and do is make the basics clear to start with, so that you should be able to tell whether it's authentic or not. There's so much variation that has been applied to it, and in fact, a lot of people individually while applying will mess around with the basic structure because the basics are not clear. So what I will try and do is make the basics clear to start with, so that you are able to yourself discard when you come across good research or bad research based on the use of PWP. You should be able to discard a bad report, simply looking at it once you understand the absolute basics. Just a brief on RNA. As far as I can remember, he was an accountant. He fell ill and he moved from Mexico to California. And during his illness, he looked at a lot of data which he managed to get, a lot of historical data. And he discovered that there was a pattern to price behavior. And that pattern has come to be known as the Elliott wave form or the Elliott wave fractal. He wrote a piece of work after meeting Charles Collins. Charles Collins actually came across him somewhere in the mid-30s, 1934-35. He came across his work and he asked him to write for the Financial World magazine, which Collins was covering, and through those articles a lot of his work got to actually reach people, and eventually he wrote the Elliott wave principles, the original work, and later on Nature's Law, which covered the principles action in real life. His work was really brought into the Financial World by Hamilton Bolton, who later on wrote several reports, financial reports in the financial business with institutional investors, and thus people came to more widely know about the Elliott wave principle. A.J. Frost later on took on from Bolton, and Robert Prechter, whose book I just showed you, The Elliott wave principle, was then written by the two of them, A.J. Frost and Prechter, together. And that book has become the Bible, the textbook for anyone who wants to actually learn and practice Elliott wave theory. Of course, there have been further iterations to the theory by Glenn Neely, by someone recently wrote about harmonic waves and so on. Theory which Prechter has written about, I have not. I mean, for me, these 200 pages in this book are everything. I mean, when we practice, when I teach, the people who actually work with me, if you don't agree on something, it's the book. You just throw the book at somebody, and not literally, but you know what I mean. And
let me come to the basics here. The basics of the Elliott wave principle. Essentially, the Elliott wave form or the fractal is the movement of mass herding. The essence of this is that a crowd or a very large group would behave in the same way when they are exposed to the same external stimuli, and that's what leads to mass psychology and herding, and that reflects itself very well in the stock market because of large participation by buyers and sellers, and their buying selling behavior, especially in broad indices, continues to reflect this behavior at all degrees of time, whether it is short term, medium term, long term. So what is this fractal? You can see I've shown it very simply on this chart. The basic Elliott wave fractal in a rising market shows an impulse or a rising trend, which is marked usually as 1, 2, 3, 4 and 5. There are rules to actually do this, and counter trend moves against the bigger trend are always A, B and C, or 3 waves which we typically mark as A, B, C. Similarly, if the broader trend is downwards, then we get the reverse fractal. The reverse fractal leads to a trend going down, being marked downwards as 1, 2, 3, 4, 5, and the counter trend upwards being marked as ABC. Now I look at, I said that this occurs at all degrees of time, and it's very important to understand the concept of how that happens. And so in the next slide I'm going to show you that how mass behavior shows up at all degrees of time, and thus always gives you the idea of what the underlying trend is at a larger degree. Okay, I'm going to quickly use this slide to show you what happens. Now, let's presume that the bigger trend is up. So I'm starting with the presumption that the larger degree trend is up. Then what would happen is you would end up with 1, 2, 3, 4, 5 and ABC, a downward sequence. Okay, but since the bigger trend is still up, what would happen after ABC? You'd get another sequence which would be 1, 2, 3, 4 and 5 and then ABC. A little time later I will get into rules as to how you can know that it's a 5 and what are the guidelines that allow you to know the right count or the wrong count, but the broad fractal would end up looking like this. And once again at the end of a 3-wave correction, you would again get another 1, 2, 3, 4, 5. So as long as the bigger trend is up, this is what the fractal would look like. Now I would like to point out that note we are looking at 5 up, 3 down at 1 degree of time. The same occurs at one higher degree, which means this 1, 2, 3, 4, 5 up would be marked as a larger 1. Okay, this ABC would be a larger 2. This would be a larger 3rd wave, 4th wave and 5th wave. So the same fractal which occurred at the smaller degree 1, 2, 3, 4, 5 A, B and C is occurring at a larger degree 1, 2, 3, 4 and 5, and then the trend turns down, because after all ABC is a downward trend. So even at a larger degree, when you're getting a bigger downward trend, the first trend down would be a larger A. Okay, so here we say that the trend is down at a larger degree. Okay, it would be B up and it would be C down. And note, as I showed you on the first in the first slide, when the bigger trend is down, the fall is 1, 2, 3, 4, 5 down, ABC up, and 1, 2, 3, 4, 5 down. And therefore this would now occur again at one bigger degree, which means this larger green colored 1, 2, 3, 4, 5 would be a larger 1, a larger 2, a larger 3, and so on and so forth. And which is why I said it occurs at all degrees of time. You could start seeing this at an hourly chart, then it would show up on daily, then on weekly, then on monthly, then on quarterly, then on yearly, depending on what kind of cycle you're following. Okay, and later on, as I explain the quantitative cycle, you will start to actually appreciate that a very large degree 5-wave sequence occurs over a 70 to 50 to 70 or 90 year time horizon, which is one financial cycle of a very large degree known as the quantitative cycle. So we will we'll look at that and how that interacts with the Elliott waveform in the later part of this presentation. But this is the very basis of how we study each chart at every degree of time, whether you're a short-term trader, medium-term, long-term. You're looking for this basic pattern and fractal at all degrees, and looking at this, it allows you to confirm what is happening. If you say it's a third wave up, it's going to be a 1, 2, 3, 4, 5 at one lower degree when you're studying it, and therefore a lot of time is spent by Elliottians all day, every day, marking these counts at every degree, at every degree of time, depending on how down you're trading. You'd go down to the hourly degree. Few people would look at lower degrees, which I would usually dissuade in non-index components because of the lack of participation. However, an hourly degree usually is good, shows these fractals pretty well, at least in most broadly traded indices. One thing that should come across to you immediately about the predictability is that note that moment you have a trend, which the beginning of a trend, it's typically a 5-wave move, which is why moment you see a 5-wave structure, which means if I see this 1, 2, 3, 4, 5 occurring here, what does it mean? It simply means two things, that if this has occurred after a preceding fall, if you have got a 1, 2, 3, 4, 5 structure, the next decline is going to be followed by another 5 wave on the upside. And this is where predictability comes in. That moment you've seen a 5 wave move in a particular direction, you're going to get another 5 wave in that direction, a third wave, similarly on a downward trend. If you started a 5 wave fall down, it's not the end of a trend. All you're looking for is a counter trend action in B, and then you see another 5 wave decline. So that's where the highest degree of predictability lies. A moment you know how to identify a 5 wave structure.
Same pattern will again repeat at one higher time period. So typically, when you read the book or read material, EWI, International Scientific spread so much word on the subject, refers to this cycle when it is 300 years long as a grand super cycle. When it is a 70-year period of 1, 2, 3, 4, 5, 50 to 70 years, which I will talk about today, the quantified cycle, then we refer to it as a super cycle. And then a smaller one is a cycle degree, and then a minuet, and so on. So they've given names to each degree of representation, but it's the same character breaking up into 5 ABC, 5 ABC, a larger and a larger and a larger degree over time. So if they are not fitting the form in one degree or the other, based on the rules which I will now discuss, then they're doing something wrong. So by knowing this, we can actually eliminate what is right and what is wrong. So getting back to the presentation. Basics, these are the basic rules of wave counting. I have written there, wave counting is the art of elimination. A lot of people miss this point. It's not particularly said, but this is what I understood. It's the art of eliminating what is not possible. You see, the rules are very specific, okay, about what should happen in the behavior of the waves. But that leaves a lot to interpretation. Okay, so people will often force their bias onto the wave count or onto the chart, thinking that no, this must work this way. So the bias comes in. The only way you remove human bias is sticking to the rules and eliminating whatever the rules do not allow. Okay, so to me, the electrical science is essentially the art of eliminating, to eliminate all the possibilities which are not possible, okay, based on the wave structure, and typically you are left with 1, 2 or 3 alternates possible, and then among them you need to come up with what is the most probable outcome based on what the setup is today. Add on other technical indicators and so on to build that bias, but you should be down to the best 2 or 3 alternates which allow you to choose what should be happening. So what are those rules? How do you actually count? Rule number 1 is wave 2 never moves beyond the low of wave 1, the starting point of wave 1. So when we look at this, basically if one started from somewhere, 2 can never go below that, because then it would make a lower bottom. So you cannot make a lower bottom, you have to make higher tops and bottoms. So that basic Dow theory is not lost when you're looking at Elliott wave. It's an extension. In fact, they actually call it an extension to the Dow theory. The second rule is wave 3 is never the shortest wave. This rule is often misunderstood and goes into a lot of debate. People misinterpret this to be the third wave should be the longest wave. It's not said so anywhere. Third wave can be the longest wave, okay. But among the distribution, essentially any one wave could be long. The fifth could also be an extended wave. The third could be an extended wave. Very rarely the first wave could be an extended wave. In either case, whether the first is extended, fifth is extended, third is extended, the third cannot be the shortest. Whether you're forming a triangle, whether you're forming a wedge, whether you're forming any pattern, the third cannot be the shortest, allows you to eliminate most of those possibilities. So you could draw a triangle or a wedge with the E through over, for those who understand a little more complex patterns. If the third is not the shortest, it's eliminated. So that's how a lot of bad counts get eliminated. The rules allow you to do that. And the third cardinal rule of counting, wave 4 never enters the price territory of wave 1. Okay. Which means this point basically does not go below this point. Right.
What I have quickly highlighted essentially that if this was wave 2, let me show it on this chart, that 2 cannot go down here. It cannot really go below this point where wave 1 really started. If it does, then it's not wave 2, then we are looking at something else. The third wave, the length, which means from the low of 2 to the high of 3 up here, this length can never be the shortest between 1, 3 and 5, which means 5 is this, 3 is this, and 1 is this. 3 itself, in terms of the size from the low to the high, can never be shorter than the other two. If 3 is shorter than 1, then probably 5 would also be shorter than 3. Then it would be a valid sequence, but otherwise not. And the third rule simply was that the fourth wave, this does not go below the high point of 1, which means this trend here cannot go below. Moment it falls below 1, then the high of 1, then we eliminate the possibility that it is a fourth wave. Then it would be something else, most probably an ABC, or maybe a subdivision, or maybe an extension in the third wave, but definitely not the third itself is complete. It's very important for me to add here that we've said two things when it comes to basically the fall of 4 below 1, which is essentially an overlap in price. It's important to understand that I mentioned some time back that the Elliott wave fractal exists at all degrees of time. It is a debate among some analysts who simply look at closing price data or look at bar charts or candle charts to count. My main issue is that and I prefer bar charts, is because if you the moment you say that the fractal exists at all degrees of time, which means it exists on a daily chart and an hourly chart and a lower, that means that if there is that means that the high and low bars are important. You just can't count on a closing price chart, because moment you will go to a lower fractal, then at that degree there will be an overlap, and that basically leads to bad counting. And it goes against the basic law of the principle itself. Therefore, I think that bar charts are the best used for counting, and so because they account for the high and low of each day, and therefore the principle of overlap between wave 1 and wave 4, which leads to disregard that it's a impulse, is to be looked at on a high-low basis. The high and the low, the high of wave 1 and the low of wave 4 on a bar chart should not overlap. Some people would eliminate it on a line chart, and that I consider is completely wrong, because it goes against the basis of the principle. But still, I find there are a lot of reports that float around in the market, making markings based on by actually overriding these basic 3 rules. And note, these 3 rules are the first 3 rules that occur on page 2 of the Elliott wave principle. We are not even gone into structures and complex structures or corrective structures. Just by looking at these 3 rules, they allow you to eliminate 50, 60, 70% of the counts which are actually not possible, and that is why these are the cardinal rules or the absolute basis of everything.
Yeah.
Why wave 3 is never the shortest wave?
Okay. Why wave 3 is never the shortest wave? I'll put it this way, that Ralph Nelson again observed from the price data and found that these rules or these guidelines are what represented behavior, behavior and prices over and over again. So it's more like a discovery which led to him defining these rules, and we are following them, pretty blindly. Okay, so it's not why it is not so. This is the rule. This is how human behavior is reflected. Yes, please.
R&D wrote something very monumental. Smarter people around asking these questions. And it is critical that we keep asking questions, because knowledge cannot stop anywhere. Markets are not stopping anywhere, mankind is not stopping anywhere. Perhaps a possible explanation. And then by trying to give this explanation, I'm nowhere trying to claim that I'm as smart as R&D. But I used to keep thinking of similar questions. And some homegrown ideas come which do get corroborated through some other theories and other explanations. See, typically wave one, the beginning phase of any market move, whether it's bear market or bull market or any time frame, is typically the first leg up. The first wave is the wave of disbelief. Sharp change in trend is still seen as a pullback, it's still seen as just one rally, इसको दे देना है. Or wherever that momentum dies, you're looking at hourly or a minute or divergence or whatever, लोग दे देते हैं. So the second wave down, or in the bear market, the second wave up, is where the trend following pressure will come and their trap will get created when wave 2 ends. But until it goes past the wave 1, and the trend following crowd starts moving into the market after the top of wave 1 is taken out. So from disbelief, hope, and then market goes to a state of euphoria. And euphoria is the most powerful emotion. From disbelief back to hope in wave 2, and euphoria, so that stretches. And typically, if markets are going to behave through a certain behavioral cycle, only then taking wave counts as valid. We will understand later in the later parts of this presentation, it is a dynamic wave count, and there must be some other correct wave count for it. And it's a very important thing he told you about the art of elimination. So after a phase of euphoria, the fourth wave that comes down is again, a wave of disbelief. Rather, it's a wave of despair. Disbelief wave 2 still, पहले की टाइप नहीं हो चुकी होती है पिछले बेयर मार्केट में बड़ा सौदा नहीं होता है. So wave 4 is where सब लोग चढ़ते हैं. And that's when margin calls, pressures, the first big jolt comes. And then the last round of the trap, the last rebound where the failed fifth will come or the final top will come. Again, the corroboration of that long-term hope comes in. And then everybody gets stuck there. The same cycle reverses again, wave 1 on the way down, disbelief, wave 2 back up time, wave 4 is hope, and then wave 3, subsequent So because the severest emotions, the strongest ones should be playing in the middle of the cycle. That is why perhaps typically the wave 3s have to be the longest ones.
Now, this fractal others at different degrees of time, it tells you something about what might happen ahead. In the sense, if the markets are falling, and then one day you wake up and you see what I have marked as a green one, you see a 5-wave advance in prices. You wake up one day and prices from falling have just started rising, and you see a 5-wave advance. What does that mean? What does it tell you? I said if prices have been falling, for a couple of days or weeks or whatever, and one day you wake up and you look at the price and you see that prices have started going up in 1, 2, 3, 4, 5. Yeah, so what does it mean? It gives you an indication that the trend has changed. Or to put it in another way, it tells you that the uptrend is not over. You see, which makes Elliott wave the forecasting tool apart from the trend following tools.
के पास में गया जन्म भूमि देखो भारत में क्या लिखा है, तो भारत में सट्टा करना लिखा है, ठीक है? बोला अगर you come to know the highest probability paths that the market can take. Very likely. In some cases you know that this is nearly certainly SI hoga. In some places you will know that the counts are not becoming clear, we need to wait for the market to give more clarity. But as new market structures arise, you update your counts without feeling the method is useless or you are counterproductive. So the art of integration, I am hoping that some people will not be as frustrated initially.
You gave me additional points to add.
So, something like that.
Once you know the rules, you know that somebody is doing it wrong, so you know what to discard also. Not just your own counts, but you know what other research to discard. Okay, so that is one part. Second, just taking from what Sushil said about where trends go wrong. So you know the best part about Elliott, since it tells you something about trend, like I said, if it's 5 or 7 things, there's going to be more trend. It also tells you where you're going to go wrong, okay, which is equivalent to what we call a stop loss. Okay, so you know your risk. If a 5 year has ended, if I actually do all my work and I know that the green 5 is the 5, you know, and at that point of time, once prices start turning down, you know, not very far away from that point, you will know with a high degree of probability, because you can see that it's 1, 2, 3, 4, 5, that the top is in place and this is your risk. You are able to quantify, so it's not just probability, you are able to quantify your risk. You are able to quantify your reward, that you're going to get this kind of a structure or so much of a possible retracement. So you have a risk and a reward quantification. Okay. No other tool which is purely based on momentum allows you to do that. Okay. Price goes above moving average, so what? As long as it is above moving average, trend is up. How far will it go? I don't know. As long as it is up, it will stay up. If it goes below moving average, will it not go up tomorrow? Again, I don't know. Okay. So then it comes down to hope. Okay. Tomorrow, let's hope that it goes back above the moving average, and if it falls by 5%, I will have to book a huge loss because I didn't anticipate it. Okay. So, by knowing exactly how much you're going to lose and how much you might make, you can quantify risk. You know how much position to take so that your loss will be equal to X and your gain might be equal to Y. C might be. So, you can go wrong. Wave 5 can extend, become a larger 5. But you know where the risk is and you know how much to risk. So that's another aspect that actually comes in. When the moment he said that you can go wrong and this, you can actually quantify risk. You know. So coming back to Nikolai Kondratyv, Russian economist, he studied the behavior of modern economics in various countries and came up with a theory. Moment he wrote his theory, he was considered to be anti-communist and capitalist, and he was jailed, executed for his work, because they didn't like the idea that he was exploring economic and political cycles, and thought he was trying to bring capitalism into the country. I'm not sure whether all his work is publicly available, but whatever little has been picked up from it has been worked upon from different angles to describe what is the quantitative cycle. Some people have tried to even correlate the mind cycle, and so on and so forth. A lot of the current work and what I'm going to present is going to be based on what Ian Gordon's presentation, which I will show has shown. He essentially shows it as a financial cycle. Okay. So we look at financial macroeconomic indicators that repeatedly behave in a particular way and thus become the essence or description of the quantitative cycle in real terms. Okay. Another attack on the quantitative cycle has been either that you know it's a 50-year cycle. Okay. That's one attack. So it's 50 years and it did work. It's not a time cycle. Okay, it was a cycle of events, of economic events, where one economic event follows the other, the third follows the second, the fourth follows the third, and then you go back to the first phase, and so on. Okay, and it's been described in seasons. And so it's not about whether it takes 50 years to complete, or 70 years to complete, or 90 years to complete. It's the cycle, okay, that has to complete in terms of economic events from stage 1 to stage 2 to stage 3 to stage 4, and then back to stage 1 and stage 2 and stage 3 and stage 4, and it repeats. It's often called a generational cycle because 50 to 70 years is approximately how long most people will live, and then they will be gone, and then again a new cycle starts. And so human behavior from one generation to the next one tends to again repeat, and so shows up in the same way, same repetitive format over and over again, even though there are changes in technology, demographics, and so on. The impact of demographics has often been brought into, and technology has both been brought into the quantized cycle explanations, and being called the cause of some of those cycles to happen. They may have an effect on some parts of the cycle in terms of ensuring that the growth phase actually takes off, but the down phase lasts longer than it would otherwise because of an aging population. However, it remains, to my mind, from whatever I understood, a financial cycle of economic factors, which I will now present. It has, in description, 4 seasons, which are called spring, summer, autumn, winter. So, it's a simple cycle. The fractal has 4 segments, unlike the Elliott wave fractal, which we look at 5 and 3. Okay. But the two do interplay on a very large time frame. Although market topping and bottoming is never simultaneous with economic data. With the lead lag, we'll see how the cycle interacts with the Elliott waveform at a super cycle. We are talking about 50 to 70 years, which is what we call a super cycle. Elliott wave 1, 2, 3, 4, 5 ABC structure. So that's what we are going to look at. So first, let's understand what the quantized economic cycle is. It has 4 seasons. This chart is pulled out of their early presentations on the subject. That is by Ian Gordon, the Long Wave Group. That's his asset management company. He writes from time to time a newsletter called Winter Warning, where he explains why we are in the winter and so on. So we look at what each of these seasons are. Okay. Spring is essentially the birth of an economy. Okay. I've shortened it so that we can quickly understand. Birth of an economy in India, we would typically say independence, but when I saw that RBI was actually formed in 1935 and the US quantized cycle starts somewhere in the 90s, I would sense the birth of Indian economy would be somewhere back then too. So birth of an economy, spring, where actually the economy starts to grow, expand, is what is called the spring. Okay. It's new, often is related to new form of growth or technology, improvement in productivity for some reason, expansion in GDP for some reason. During this period, prices of assets, labor, money, commodities expand in direct correlation, okay, and they expand slowly throughout this phase. The second stage is called the summer. Okay, this is when the spring has zoomed to a point where growth is widely prevalent. Okay, all the resources of the economy eventually get exploited to the extent available at that point of time. The eventual reaction of booming summer period is you do end up with price inflation. Interest rates expand along with growth and reach a point where they become excessive, and then at the end of the quantized summer, you get a cooling in the economy. So the end of summer is essentially one on high inflation and interest rates. Just before the summer ends, what happens is that because of the business cycle which turned down during that period, interest rates and inflation actually start contracting. And the sense or the belief at that point of time is that you finally control these two completely out of control factors. We have full control over inflation and interest rates. We know how things are going. And the low interest rate base causes a boom. Okay. And that boom is called the autumn boom. Okay. This is the late autumn boom. It's typically the bubble, the final stage of the cycle. This is the only period during which we see inversion in interest rates and inflation and financial assets. Okay. The belief at the end of the period is that they are inversely correlated, and that's how things function. If rates come down, markets should go up. If rates go up, markets should come down. This is the typical philosophy of a quantitative autumn. During this boom phase, credit tends to expand because of low rates. There's a consumption boom. Near the end of the autumn, attempts to actually keep the autumn boom going can actually lead to higher levels of debt. Often a huge expansion can happen in debt levels at either the government or banking levels. asset prices reach bubble levels. Everything of commodities, real estate and wages expand during this phase. And the last phase is the winter, which eventually always follows that bubble. Once it bursts, the timeline is not known. When I say timeline is not known, is we've seen winters, for example, the US winter, the last one, which is always referred to as the Great Depression from 1929 to 1932. 3 years, the stock market lost 90%, bottomed up. Very short time frame. Japan, 1989, till date, still deflating, 20 years plus. So what I meant is timeline is not known. Is essentially how fast you're going to unwind or not varies. Is this because of the demographics? Maybe is it because of political action? Whether the political action is instantaneous in the 20s, in the 30s. US took action to instantly, just reboot the system. If something is bad, let it fail, let it go bankrupt. If not, let it, and let the economy just resurrect itself. And that's what it did. And if you try to slow things down, it could take years and years of unwinding before you actually reboot the system. Which path you choose could be a political issue, could be a demographic issue, which is not really addressed. But essentially, a winter would end. It ends in two things. One is stock market, asset prices, and third is the economic data itself. Sometimes the two would have a huge lead lag. It's possible, like if you see the 30s, your stock market would bottom in 32, debt to GDP would continue to fall till the late 30s or 40s. So in terms of economic data, we will say the winter ended in 1940 or 42. The turnaround would occur after that. Okay. But essentially, a deflation or a depression, contraction in credit, is what you get. The last point I made actually is whether most people would have observed or not. In the 2010 Indian budget, it was announced that we would be looking at tightening our fiscal situation. It often gets overlooked that that actually means a reduction in money supply, a reduction in debt, and therefore an impact on business. Even though the stock market continued to move for another 6 months since then, the indications were already there from the government side. Now I'm looking at another chart from the long wave group. This one parts out 4 quantized cycles. The last 2 are most obvious in terms of data because more data is available. In past data, different fields are being used to represent the same thing. And I'll try and explain to you there are 3 factors basically at play in the cycle. One is debt to GDP, which is not on this chart. I'll show it separately. The 2 key other factors are interest rates and inflation. This blue line, okay, the dark blue line is basically interest rates. Okay. The green one is inflation. Originally, they were using, he was using CPI data and then he used the CRV index. Though I believe CPI data would be more accurate in showing you rate of inflation. Okay. So what happens now? I'll show you for the last 2 cycles. This is where the US quantized spring would have started. Okay. In stock market terms, I believe from Edelweiss data and work, it starts actually here. Okay. This is the plateau. Okay, you see the flat market. This is where you get the peak in interest rates and inflation. So now when you see PPI data, you see interest rate data. The peak occurs here. Okay, in this plateauing market. When that market takes off into the autumn bull market, which is the final, the autumn bull markets typically have a year of 8 to 10 years, but as we've seen in the recent US market, it was longer. So I explained that. So this 7-8 years, from 1921 to 29, you had the autumn bull market. Now you notice inflation at the peak of that boom was at a lower level. Interest rates were much lower. You did get a spike in interest rates somewhere at the fag end of the whole period. And then after that, interest rates continued to decline even as the markets continued to move up. And then moved up as the markets moved toward this phase. Okay. Then again, in the 70s, you see plateauing here. This is a new quantized cycle. It started from the late 30s. Okay, where interest rates are going up, markets are going up. You have growth, and you have a plateauing period where interest rates peak, inflation peaks, okay, and inflation starts coming off, interest rates start coming off, and that kicks off what is known as the autumn boom, okay, the autumn cycle, which is always typically followed by a recession. I mentioned earlier that one of the criticisms to the quantitative cycle is because a lot of people started calling the US winter as early as the 90s because it had run a 10-12 year course of bull market, and when you got a recession in 1994, they thought this is it, and it didn't happen. What you really need to study, therefore, to understand what would have happened in these 10 years, it's not that the cycle didn't work, the cycle was still an autumn. You managed to extend an autumn. How did you extend an autumn? There are basically two key factors here, which is interest rates and inflation. As long as you can prolong low interest rates and low inflation, okay, you can prolong a quantitative bubble, autumn bubble market. How do you do that, and how did they do it? Because of years of development and probably from some of the experiences of the 30s, the world moved towards globalization over time. It was possible for the US to actually move manufacturing overseas, to move services overseas. So there was a lot of arbitrage in labor, arbitrage in manufacturing, which allowed them to keep inflation sustained at a very low level for a long period of time. That simultaneously allowed them to keep interest rates low for a very long period of time, and therefore debts could be serviced at a much higher degree than ever seen before. Typically, I'll show you one more chart. Debts. So at the peak of 1929, the debt level for, and this chart is from Agate Wave International, was close to around 140%. Okay, and once that crash started, because GDP contracted, the debt to GDP actually shot up. This is after the market started falling. Okay. So the downdraft actually starts at a much lower level. Typically, somewhere close to, once you're close to the 150% mark or 120% mark, anywhere there, once you have pressure on interest rates and inflation, the cycle starts. What causes that pressure? It could vary from cycle to cycle. And then eventually debt to GDP comes down, plateaus all the way into the late 40s, 50s, and then again starts growing. Right now it has grown exponentially to a level of almost 380%, off from 390 at the peak of GDP for the United States. And that's what I was referring to, that it's possible to have reached such a high level simply because we controlled these two factors. Similar thing happened in Europe with the Eurozone being created. A lot of the countries that were already high on debt to GDP as early as the 2000s were able to move to lower interest rates because of the Eurozone. So these were financial restructurings that allowed the quantitative autumn cycle to actually extend for another 5-10 years till debts really reached a much higher level. So now I'm going to show you first in super cycle sense, what I see from all this is that since the stock market boom is a super cycle and the quantitative cycle itself is a 50 to 70 year cycle, a 5-year pattern at super cycle degree very much coincides with the quantitative cycle, starting with spring and ending with the autumn. Okay, and the winter coincides with the corrective phase, an ABC correction at super cycle degree. Okay, which is very obvious when you look at this chart. Okay, when you see this entire move from year to year. Okay, and then this sell-off where markets fall significantly back. I'm not showing you waveforms, but essentially AWS waveforms for this entire period, this is a 300 period, 300 year period are a super cycle degree wave 2 year, and then they've counted this as 1, 2, 3, 4, 5 ending at the peak of 1929. Okay, the fourth wave essentially is this plateauing period, which is the quantitative summer. Okay. The same thing repeats here. Okay, that you have wave 1, wave 2, wave 3, and wave 4. Wave 4 is the summer, the plateauing again. Okay, and wave 5, which is the autumn bull market. So that's the simple similarity which I am seeing in both these markets. I see it also in the Indian market, which I will show you. Okay, which is why I put it like this. That the wave 4 in 2 instances, and the third one even in India, coincides with the summer. Okay, and the autumn bull market follows, and then you have a winter. So where are we now? This is a chart which uses backdated data thanks to ASA software. Vivek Patil has backdated data with the British advisor all the way down to the 1940s. This allows you to see what I mentioned, that our stream would have started somewhere in the 30s, okay, because you see the first impulsive rally way back then, which I marked as wave 1 and wave 2, and then you had a huge bull market, an extended third wave, okay, which lasted for several years, several decades. I don't know how many of you have actually been around through the 90s bear phase. I have, and I very well remember the high interest rates and inflation that we saw during that period. 1995-96, newspaper ads would be full of double your money in 4-year schemes. Interest rates being offered by banks, leading public sector banks, would be at 14.5% per annum, 15% per annum. People who have been in the market long enough would have that memory. People who have just come to the market will not be able to relate with that time frame because they've never seen a business cycle turn up and turn down and be down for 5 years, 6 years consistently. 94 to 99 or to 2001 was one down cycle for Indian business. The only sector that did well was the tech sector because of the external factors. Apart from that, the domestic economy went through a downdraft for that entire 5-6 year period. There was sectoral rotation, which is again typical of quantitative summers. There was a peaking of interest rates and inflation, okay, during that time. And interest rates and inflation ended up at the lowest levels, at very low levels out here, where I have marked wave 4, okay, after the tech boom. That's when housing loans started dropping to below 10%. They went to 8, 7, floating rates hit 7 or 6.75% at their lowest. And that requires me to plot that data, which, when I wrote my original article a year and a half back, I had not plotted it in the same format as the US data which I showed you, but now I have, so I can show it to you. This is CPI inflation. UNME is urban non-manual workers, basically urban CPI inflation. This data is no more continued by the ministry. Now they have come up with a new series from last year, which full 1 year data will only be available, I think, from February, which is for urban inflation. They have a new measure which they released. They no more give you this UNME data, because the UNME data, moment it hit double digits, they stopped giving it. And they said now we'll come up with a new one which will give you a correct output. But I doubt it will vary very much from this, because I've seen the averages of those data. Basically they've averaged, they've just changed weightages for some items up and down from what they were using earlier. It doesn't make so much of a difference. My point here is, from a quantitative perspective, you had high inflation throughout this period, 70s, 80s into early 94, and then you had a sudden drop and a very low plateauing period in CPI. Okay, this is what marks the end of a quantitative summer. Low interest rates, low inflation. So I need to show you interest rates as well. This is Indian interest rates. Okay, the bank rate dating all the way back to the early 19th century, and the SBI advance rate from the 70s. These rates peaked here in 96 or 94, somewhere in that range, 94, 95. That's where the business cycle ended. Okay. They dropped into 2003. So interest rates and inflation both dropped. Okay, and that's where we got the autumn bull market, which started in 2001 all the way to 2008, or for some in early sense up to 2010. But there is a divergence. See, this is the whole point. How do you identify that you are in an autumn bull market? There is typically, in all three instances, I see a divergence in interest rates and inflation at the peak of the next move. I showed it to you in the US data that when you had the final autumn bubble market, interest rates and inflation peaked at a much higher, lower level than they did in the summer bull market or in the third wave of the super cycle. The same is true here. India's super cycle third wave, according to me, ends here in 1994-95. The fifth wave ends here in 2010 or 2008, either way, and interest rates and inflation are at a much lower level than they were in the past. And this is where the inverse correlation of rates with markets actually should, based on the theory, come to an end, which means that you will see a weakness in economic activity and a lowering of rates as the winter gets deeper and deeper. So the phenomena right now and the expectation of right now markets is that interest rates start coming down, markets are going to start going up. Okay. That expectation is actually defied by this data. This data or this cycle says that that's not the case anymore. Okay, that inversion is true only in the autumn bull market. That inversion is not true once the winter comes in, and it's not true during the spring. Okay, because spring is a growth phase where money demands price and there's a demand for money, and winter is a phase where there's unwinding, and even if you offer money at lower rates, nobody wants it, or the people who are offering it don't want to offer it. Even though they are offering it at lower rates, they want quality loans only. That's what tends to happen. The reasons for a cycle turning down can vary, which I'll explain what I mean by that. It's very easy for us to say, no, India is a great place, it can never have a winter. We're all going to work hard and make sure that growth is going to happen. Government will step in and do something about it. If that was the case, then the Great Depression for the US would have never happened. The reason it happened was not completely because the United States was in trouble. As I showed you, their debt to GDP was at the same level that ours is today. This is India's debt to GDP ratio. It is at 135%, almost 140% this year. If you add variables, it would be a little higher. It's at the same level that the US was in 1929. The reason that happened is because it was a globalized economy. Even then, for them, troubles emerged in other parts of the world which you could not really sustain. So what's going to happen? Is it going to be a domestic problem of credit? Is it going to be a global problem? What is going to cause the downdraft? The reasons could vary, but it's an economic cycle that follows one step at a time in the format that I've shown you. This is a closer look at interest rate data. Okay, so basically it's showing this portion, okay, this segment, I guess, because from Bloomberg, this is the treasury yield, the 10-year government securities yield chart, which is available only from 98 there, and it shows the same thing, that interest rates actually dropped, very sharply, and they've been trying to move up, but they're at a much lower level than they were earlier. Okay, it's making a secondary attempt to move up. Would it actually reach the upper end of the channel, which would be around 9.75%, or will it just stop out here, as most people are trying to say, no, interest rates will turn down now? In either case, so far to me it looks like this could be a corrective period after which interest rates actually start going down. And what the quantitative cycle explains is that that would happen along with weakening economic activity for some reason. Whether that reason is domestic or it's external. So I think I've covered most of these charts. It's one more economic divergence that I found recently, and it was also published, I think, in the Financial Express in another format. How much of household savings has been going into equities? This is the percentage, which is the amount of money actually going every year into equities. The second measure, which I have not put here, which was published, was how much of household savings are invested in equities at a point of time. Because there are two measures. What has happened in this data, from my memory, somewhere down to 1992, the Harshad Mehta boom period, when that scam happened, prior to that, the interest in equities had reached a point where the ratio of equity investments to savings had actually almost reached the 20% mark. It didn't cross it, but it came close to that. And from there on, it has been declining ever since. From 2001 on, a lot of people thought that this would actually take off. People would invest more in equities, and the boom would really be a sustained one because the ownership of equity is really low in India. 10 years down into the boom, the ownership of equity in India as a percentage of savings is in the single digits. It's less than 5%. And the annual flow, which is what I'm showing here, is also in single digits. In fact, it's negative once year, and it's also negative this financial year. Okay. So essentially, this shows another divergence in behavior towards market in what I'm calling the autumn cycle that has ended, and it's more a directional. Most people would say, no, this means people are not buying, market must go up. This is standard logic. If nobody owns equities, it has to go up, it can't come down. That logic does not always hold true because markets essentially reflect mood of the investors at that point of time, and the mood based on this data is essentially not exactly positive, and it's unlikely to have a direct correlation with the market. It might when the next cycle takes off, but as far as this cycle is concerned, this is where we are. Since independence, it should be the first wave of discontent. That's the question. Whether this will be the first one? Yes, this will be the first one where people will get really angry, and by the time it's over, we will have dramatically changed something. And let's see how that happens. The question you ask actually relates with studies in elite wave analysis and social mood. A lot of work on that has been done by Robert Richter in the last decade. He's even set up an institute of socionomics, which is now trying to run mathematical models on all kinds of social and other forms of data, and be able to look at how you can forecast that based on mathematical modeling. But the essence, bottom line of the thing is that when you have bear markets, and especially of larger degree, then a bear market or a downward trend in stock prices basically reflects negative psychology or weakening psychology or a negative social mood. The larger the negative social mood, it leads to disruptions in society, which is basically the effect of the weakening social mood and not the cause of a falling stock market. So markets fall showing that mood is getting worse. If it's a larger degree bear market, that weakening mood shows up in all kinds of upheavals, whether they are civil wars, civil issues, or global wars. Those typically they occur at the start or the end of a cycle degree, super cycle degree bear market. So your answer is that we are going to see the first one, and Anna Hazare might be one of those manifestations. Whether it ends in that or something new comes up in the year ahead, we will see. But those are manifestations of negative social mood.
We don't see bursting of the bubble anywhere. Secondly, if we see the last 3 cycles which were discussed, they were before 1971 and after 71. Till then, gold and currency were interlinked. Now gold and currency right from 71, they are not linked. So a fourth parameter comes into picture. Will not affect the nature of this graph.
Okay. We covered a lot of points in there. One, there is a financial cycle of money, which is reflected in inflation and interest rates. Money takes different forms. It could take the form of printed money, currency. It could take the form of debt that is created. Whether money is linked to gold or not, it is money. So money could expand linked to gold by devaluing money in ratio to gold. Money can expand without being linked to gold by expanding money supply. So money expansion, the financial cycle up and down continues irrespective of whether you are on a gold standard or not on a gold standard. The only impact it has is on gold prices. Okay. Second, we have moved from fixed currencies to floating currencies. That will definitely have an impact on the way currency markets behave to the ongoing phenomena that they would have done in the past. Okay, but they do not change the phenomena. Okay, so that the world is going through a countertide winter at a larger scale, and that we will go through one at a smaller scale is one part. How will gold behave in that, and how will currencies behave in that, is something that needs to be explored. So let me just answer your question in a little more detail now. One of the ways that the quantitative cycle is actually measured, okay, since you asked that question, is by measuring equities in gold. Okay, this is a chart again from the Longwave Group and even Elliott Wave International. Both of them published this chart. This is a chart of the Dow in gold terms. Okay, since you asked about gold, so what they do is rather than look at gold as whether it was on a fixed rate or floating rate, they just divide the two and they look at the gold-Dow ratio, okay, and therefore it shows a bull market or bear market. So what they say typically when you enter winter, okay, the gold-Dow ratio tops and starts falling. So that is what you notice. You notice it here, okay. This is the gold-Dow ratio and it starts falling. Okay, here also same, the gold down ratio topped in 2000 and starts falling. For that reason, sometimes they also mark that the fifth wave has ended in 2000. Okay, it marks it that way. Although when you actually look at the chart, it is debatable. I myself mark it in 2008 sometimes, and I feel it's an open case because you can fit a 5 wave into the 2003-2008 period, and there are elevations who do that. Okay, I'll show you an additional reason why also from the Dow chart. So irrespective of that, but they broadly say that the winter, so in terms of economic parameters, looking at Dow and gold, they say the winter starts here, irrespective of where the fifth wave ended. Okay, the winter starts when the Dow gold ratio peaks. That is how they look at it. And it bottoms when the ratio bottoms. So right now they say the ratio is still here. In reality, it's already reached somewhere down here. And unless till it is reached down here, they will not be calling it a bottom for those markets. Okay, so that's how they look at that ratio. Behavior of gold itself would vary. So if you are on a fixed gold standard, when you are deflating, basically what does deflation or depression mean? It means a contraction of credit, a contraction of money supply. Okay, when that is happening means the amount of currency in circulation, which is still available, not destroyed, goes up in value. Okay. Now, if you are on a fixed standard, how would that increase in value get reflected? It would not, because you would be so many rupees is equal to so much silver or so much of dollars is equal to so much gold. It would not get reflected, the strengthening value of the underlying. But if you are in a floating rate system like today, it will get reflected. So the price of gold changing will actually reflect the changing value of the underlying currency. Okay, so if the economy is strengthening, or rather if the currency is strengthening, gold prices would actually come down. If it is weakening, gold prices would actually go up. So that is what we are going to see in the current situation, because everything is floating. But that doesn't mean that it has an impact on the winter cycle. Interest rates are coming down and will come down, and inflation will come down. How currencies and commodities and gold play is going to be a little different than it might have been before. It will come down and inflation will come down. How currencies and commodities and gold play is going to be a little different than it might have been before. But commodities is a different section. I'm only saying gold. Now you are saying commodity cycle. See, now there are two things. One is inflation and one is commodities. Okay. When we are measuring inflation, the inflation cycle peaks in the summer. Okay, it is weak, and then there is or isn't a secondary spike at the end of the autumn. Okay, like we are seeing right now in India, and sometimes it can happen at the end of winter also, because at the end of our economic winter, the politicians or the government will try to intervene and kickstart the economy again. They have done so again and again in every down cycle. So every time the cycle hits a low end, they try to inflate it again, because it's contracted, so much of money has been destroyed by contracting debt, defaults and so on. They say, no, let's start it again, let's spend so much money in the system and try and start it once again. And so as and when they do that, you do get run-ups in commodity prices. Okay. So there are two things. One is in the short term, commodity prices can tend to fall through a deflationary period, but at the end of that, they would reverse and rally strongly because of the monetary spending that comes in to push the economy up again. So, what am I missing then from your
The first part which I asked you about, we are not noticing any versus of dollar.
No? We have not noticed the bursting of bubble in commodities.
Either in commodities or in real estate. Neither of them.
In India.
In India.
In India, yeah, because you see, the Indian stock market has had a significant lag with the world market. I mean, like they're showing you Dow gold ratio topping out only in 2000, okay, which means it's had several years for something to happen. And even then, you had a real estate bubble in 2008, and then it was in USA and so on. There are many other countries where real estate prices have been elevated. Only just started falling in China. Now they are still elevated in Australia, in Canada, I think, not Australia. So, the same is the case in India. There is a lead lag. You go back to the 94 cycle. 1994, the stock market started falling. Elevated till 1990. Right? That is 2.5. Lead lag between markets. Asking me if or what the mid cap index. There is always a lead lag. There are 2011. They may have made a new high. So, that kind of between sectors of we are not looking at it happening today. Okay, stock market has been falling for more than were falling, but rupees depreciating. So in Indian rupee terms, commodity prices are not falling. Will they? Maybe, maybe not. Inflationary spike before that happened. So this spike might even continue. I don't know whether the treasury yield is, like I said, I don't know. Inflation come again, interest rate come again, but inflation is still at 9% plus. If the rupee depreciates and inflation comes up again, if crude goes to 100, like I am forecasting right now, possibly, then interest rates could get raised and you could reach the upper parallel line, which is at around 9.7 to interest rates before the down cycle for interest. So there are a lot of short-term variables at play, but broadly what I am saying is that the economic cycle has turned. Okay, we are in a period where from
due to the poor audio from there on, I'm going to take over this presentation. And I think this is a very important point in the presentation, essentially because I'm making it in just a day after, 2 days after the budget for the year has been presented. At that point, when it was not very clear in terms of the market. The mood was really negative. It was possible that the next leg down of the market could have started then, but yeah, what was not clear is where were we really poised in terms of interest rates and inflation, because these, like I've mentioned, these are the two key factors for extending the autumn bull market, which a lot of people thought in India could continue, and those are the risks that had to remain elevated for it to slow down. So when the interest rate policy in Jan was presented, saying that no, rates won't be raised anymore, could probably go down, it definitely created hope for the autumn bull market to resume or at least continue for some more time. However, I think after all these announcements of the last week, my sense is that the situation has not yet started changing. It's clear from the interest rate policy that there are risks to inflation, and which is why when you just look at this bond yield chart, the A equal to C target is still at least 150 basis points higher from if you look at the parallel channels, close to 10% on the bond yields. If you achieve equality, there is room for unknown or unexpected spikes in case there are inflationary risks from the spending that is going on in the economy, or even the process of rolling back subsidies that has been spoken about, or any hikes in taxes like some that we've seen right now. So because of these underlying risks, RBI held back, and the government has actually gone ahead and highlighted these are measures that they might have to take. Puts a very clear picture on this cycle not being complete, being at the fag end definitely, but with clear risks, and I think that's going to play. We are in the final stages, I think, based on that of these cycles and their impact on equities themselves. So I think I wanted to add that, and then actually go and look at some of the charts that I've added here. Since the discussion went on gold, the gold Dow ratio, I thought it was worth looking at the gold index ratio, and therefore I did some backdating on gold, what gold would have been in INR. Most people know that in dollar terms, gold prices peaked somewhere in the early 80s and then remained down all the way till the late 90s, and then the next move up only started somewhere in 98, 99. When you look at gold in rupee terms, you find that it has been gradually moving up throughout this period, and this has essentially been the impact of a falling currency. The USD INR used to be below the 20 rupee mark back then, and has went up in during the liberalization period as we depreciated the currency. And now it's risen. Gold prices in rupee terms have continued to rise to date, and even while there are predictions by EWI for gold falling in dollar terms, and we have seen recent loss of momentum. I myself have been writing for downsides. Depreciation of the currency, if it happens for whatever reason, can actually keep gold prices elevated, or even commodity prices elevated in India. and that remains one of the risks that we face, or at least the immediate benefits of deflating prices does not come to us. This is of course again then a rupee of chart of the USD INR itself. Again I backdated it based on the silver devaluations of the early century, and I was able to therefore mark wave 1 somewhere in the late 70s. Then it went into wave 2 in 1980, third wave started, and that was an extended run which went all the way to the year 2000. After that we've seen a 3-wave decline into the year 2008, and from there my sense is we've seen the first wave of the fifth wave that has started, a larger fifth wave. So we've seen 1 and 2 of that, and we are now in the third, and therefore my targets are again for it to attempt the upper end of the channel, which is way higher at 80-90 rupees, at least the first parallel channel. And that target right now to most people appears to be unrealistic, essentially because we are on floating currency rates, unlike the fixed rates before. But I've shown for various reasons based on this and based on the basic value of the minted currency, why the true worth is much higher. Whether we get there would be a function of flows, money flows, demand and supply. But that in a globalized environment where money supply is likely to contract remains I think a major risk that most people do not really factor in. Still, I would say that there have been a lot of steps by the government allowing foreign money into Indian debt, even in the budget allowing for ECB money to come in. So they've taken steps to see that it does not happen. However, the wave chart, the wave count suggests that it's a third wave and it should be headed higher. So how that really unfolds is something we need to watch out for. Third, the Sensex gold Dow ratio. I showed this too in January, and there's not much change even though the market rallied 20%. We have seen the gold Dow ratio actually move up only marginally because gold prices have fallen off quite a bit in the last quarter. And have remained lower, so the ratio is really not taken off a lot. It does look like a big head and shoulder. If you see where the gold Dow ratio was way back in the 70s, it was at a much lower. And I'm saying gold Sensex ratio. It was at a much lower level in the 80s. It's moved higher. In fact, this ratio did not reach the 2008 highs, even though the index reached there simply because of rising gold prices. And now if either gold prices rise or the index falls, or both, you could actually see this ratio coming off further. But the cutoff point would be 0.17, where you could actually say no, this is not an HNS, it's a failure, and that's probably based on the 20-year range. Since the 90s, we could be at the lower end of the range. However, if that breaks, it would end up being a big head and shoulders, looking for lower levels in terms of this ratio. Okay, this used to be essentially has been my count. When this bull market started in 2000, I used to think that we've started a bigger third wave, something that a lot of people still say. But once I understood this DKF cycle and simplifications, it's been on the back of my mind that this count could be wrong, and I've therefore shown some in my earlier slides based on the quantitative cycle why I think the bear market of the 90s was essentially the fourth wave of a very long-term degree based on the components of interest rate and the macroeconomic components that existed at that time, and therefore it's only the fifth wave of a 70-year quantitative cycle, and we are actually correcting that, and therefore this can't be 1 and 2 out here. It has to be the fifth ending and the corrective bear market, a much deeper one. This is the Dow count on the Dow Jones, and while it can be marked as a fifth ending in 2000, I was never comfortable with the fall. After 2000, it was corrective, and simply because there's equality between the early 80s rally and the 2003 2007 rally. It's possible that this was an extended third wave, this was the fifth wave, and this was the first wave, and it would fit very perfectly. And therefore what you've seen, the sell-off in 2008-9 was wave A, and what you're in right now is wave B, and wave C down of the bear market is still pending to happen. On the Indian market, my Sensex count popularly has been the fifth wave ending in 2007, and that's because the lowest price point of the 90s to 2003 bearish business cycle or fourth wave was in 2001. However, in the Nifty, 2001 did not break the low of 1998, and therefore it's possible that we actually mark the entire period as 1 and 2, the tech bubble as 1 and 2, and then third, fourth and fifth. Some people, and there's also equality between these two for the similar reason as in Dow. It's not completely impossible to mark this as a 5-wave structure ending only in 2010. However, I'm still more comfortable because of Sensex and various other older indices peaking in 2008 and breaking the 2098 lows in 2001, that I think the rise in 2008 to 2011 was corrective. Even my smaller degree counts are mostly ABC x ABC, so it's not a count I'm comfortable with, but I'm just saying for those who are looking at it this way, it can be taken in this way as well. So this is my preferred count as always, that the fifth ended in 2008. We saw a bear market, which is W. We seen a larger bear market rally, which I've marked as X. We are in Y. I thought for some time that this channel breakout rally, which started from December of this year, could have been a larger X. However, in the last 1 week, we've seen faltering of the rally near 56.30. And it could still mean, as I've shown here, A, B, 1, 2, it could still mean that we are only in wave 2 of C, because the starting point, which means the high of B or the starting point of C, has not been surpassed, and that gives confirmation, or rather at least lends some support to the idea that we could still be in C2. And the risk at 56.30 for that view was very small, because we'd already almost retraced 70 to 80% of C1 and C2. Only thing C2 is an expanded flat based on the count that I've shown, and as long as we are below 56.30, that would remain my preferred count. So we are still in the big Y down, and we've probably started the third wave of C down in the last week. People asked me in my January presentation whether it was happening then. I did think till December, but in Jan I was not so sure, so I didn't really make a mention of it. But I think the evidence that I've seen in the last week, and even the indications from these recent events, which tell me a lot about interest rate and inflation over the next 6 months, are an indication that we are the time for C3 is probably right now, and probably over the next 3 months we should see that unfold, unless something changes along the way, which I will keep updating. I think there will be more clarity on whether that view is right on Monday if we open below and stay below the 5268 Nifty level that I've discussed in my shorter term updates. Now, but coming back to the bigger wave structure, so I'm looking at 2 and 3 down having started, or probably starting soon. This is where we were at that point when I was discussing, as to whether 1, 2 and 1, 2 is here, but essentially it's wave 1 at the bottom of September and wave 2 in an expanded flat up to the recent high. That's what I'm showing in these charts. So these are the charts that I covered, and I think I've also covered my recent view on where most of these charts are stated. Even on the Dow, we've essentially retraced up to 78% of the bear market now, even though we've gone above last year's high. We are still below the 2008 highs, and only a retracement, and the rally recently continues to look very much a corrective move, which as in where it ends would see the next leg down start. So that's all. I hope you've enjoyed this presentation. It's a 1 hour and 25 minutes, gives you a deep insight into the quantitative cycle and where India is poised within that cycle. Even though India started off late in its autumn bull market versus the rest of the world, an 8-year bull market is usually sufficient to complete that, and now that puts us along with the rest of the world in the same situation, facing a situation of high debt and a need to actually unwind. I think it's very apparent when you let me since the event is just gone by, let me just look at the debt to GDP ratio and tell you, because this was this chart was a lot in discussion over the last couple of days. What is apparent here is that India's total debt to GDP continued to rise throughout this period. You can see it's I've been mentioning it somewhere between 130-140%. It could be higher if you take into account a lot of numbers which are not fully available, but purely based on government debt and private debt. That's the number that I got. But what you can clearly see is government debt has been falling since 2005 as a percentage of GDP. However, during this entire period, post 2003, government debt has actually grown at a higher rate in terms of percentage annual growth than it did before that. So, even though the ratios come off, the rise essentially has been steeper in actual numbers. And the reason for that has probably been the growth in nominal GDP, which is GDP plus inflation. And another way to look at it is probably the movement of debt from the government's hands to private hands. So a lot of the leverage that has built up post 2005 has been in private hands. The government has been very careful about its budget, and you could actually say they are doing a good job of deleveraging themselves. However, while they've been deleveraging, the rest of the economy has been leveraging up, and which is why the total debt to GDP number, because of growing banking credit, is quite high, and which is why so much concern is around interest rates and inflation. And as I've explained in most of this presentation, those are the two key factors that will remain the biggest pressure points for the macroeconomic picture for India and the stock markets. So let me end this presentation here. For regular market updates, you can continue visiting indiacharts.com and become part of the mailing list, and you will be updated. But this presentation, I hope, has given you a lot of insight over the big business cycle that occurs and where we stand in that, which is popularly known as the quantitative cycle. And also I've covered the basics of Elliott wave analysis, the very basic foundations of wave counting, which once you understand, you'd probably not make the most common mistakes, or your confidence with the subject would be far higher than it is with most others who are using the subject. And if you're someone who reads such analysis, you would be able to identify good research from bad research, or at least know if someone is not really following the principle to the T. So thank you very much for supporting these event India Charts and the work that I've put up.